So, let's start with the accounting profit. For the purpose of this standard, it is defined as a profit or loss for the period before deducting tax expense. So careful. When I speak about the accounting profit throughout this video, I am referring to profit before tax. Why? Well, to be consistent with the definition of taxable profit or loss, which is the profit or loss for the period determined in accordance with the rules established by the taxation authorities upon which income taxes are payable or recoverable. Clearly, as tax rules in your country might vary from accounting rules applied in your company, there will be some differences between these two. Namely, those are expenses recognized but not deductible for tax purposes. For example, in some countries, expenses for business lunch with customers are not allowable for tax purposes. In such a case, you would have to add these expenses back to the accounting profit in order to come to taxable profit. Then there could be some income not recognized in the financial statements but included in the tax return. For example, in some countries, interest income is taxed on a cash basis. So interest revenue for 20x2 that was paid to your company in 20x3 would be income not recognized in 20x3 but included in tax return for the years 20x3. In other words, you have to add such income to the accounting profit of 20x3 in order to get taxable profit. Another type of a difference might be expenses not recognized in the financial statements but deductible for tax purposes. Similarly, as with interest tax on a cash basis, there could be certain expenses allowable only when you actually pay them. For example, in some countries, special bonuses to employees are allowable only when paid. So bonus expense for 20x2 but paid in 20x3 is the example of such a difference. Then there could be some income recognized in the financial statements but not included according to tax rules. For example, some government grants received might not be taxable at all. Now,